Welcome to the Value Investor Chatter podcast. My name is Becco, and I have a very, very special guest today with me, Alex Morris from the Science of Hitting Investment Research. Welcome to the podcast, Alex.
Yeah, thanks for having me. I'm excited for this.
Awesome. Well, thanks for doing this. Before we get started, just a quick disclaimer: this is purely for educational purposes only. Please consult with your tax and financial advisor if you're going to make any decision on your finances. Okay, with that out of the way, let's get going. So, Alex, again, thanks for hopping on. I thought, I reached out to you on Twitter, it's where a lot of the hive mind of investors on Twitter. I reached out to you there. Your Substack, obviously a big hit. So why don't we start with introductions? Tell me a little bit about yourself.
Sure. Well, that could be a very short answer or a very long answer, depending on what you'd like. Maybe the shortest way to say this is, I kind of became obsessed with investing in, call it the mid to late 2000s. When I was in college, I went to school for building construction. My dad's a plumber, and I kind of just followed in his footsteps. And I kind of quickly realized it wasn't really the path I was interested in. And I stumbled on the Berkshire shareholder letters around that time. And I had, I had a business that I started with a couple of buddies in college. So I had kind of a entrepreneurial / financial business interest, but I didn't know how to kind of apply it up until that point. And then I found investing, and yeah, that was probably 15 years ago now. And the fire is burning as strongly today as it was then, if not more so. Hopefully I've become a little bit smarter over time. So yeah, around that time, a few years later, as I was finishing up at school, I went to the University of Florida. I was trying to find a job in the investment industry, and I didn't totally know how I was going to go about doing that. And early efforts to find a gig at a mutual fund or a hedge fund, things like that, didn't seem to bear much fruit. They wanted someone with a bit more experience, CFA, MBA, all that kind of stuff. And, I had to get from A to B. So I started writing online around that time and started, trying to build a name for myself, improve communication skills, those types of things. And once I found a job in the industry, originally at a small firm in Jacksonville, Florida, eventually moved to a larger firm in Savannah, Georgia, working as basically a buy-side equities analyst, and also continuing to write under a pseudonym, Science of Hitting, or TSOH. I think maybe one thing that I think could be helpful that I kind of learned through that period, especially for younger people who are getting in the industry, I kind of always made it a point to put my interest in terms of the areas I want to be focusing on ahead of, potentially career advancement or compensation. Not to say those things were certainly relevant, but I always made it incredibly clear to employers kind of where my interest and where I wanted to focus kind of lied. And I think that's an important part of being, it's really hard when you're first coming out of school, obviously, but as you get into your mid 20s or getting into your 30s, if you put a lot of time and effort in, I think you need to start putting your foot down a little more to ensure that you're, focusing on the areas that you care about to the extent that you have that passion. So I continued to stay on the kind of equity analyst side of the business. And, again, my writing and the things I do on Twitter and the like were kind of perfectly aligned with that. That kind of brought me to the start of 2021 when I launched the TSOH Investment Research Service. And I've been doing that for the past 2 years. And what it is, for anybody who doesn't know, is I effectively took all the work that I was doing over that, 10 plus years prior to launching as an equities analyst. And that's kind of the output of the service. It's just complete transparency around my own research process, my own investment process. I disclose everything I do before I do it. And, it's all encompassed in this kind of long-term investment approach. And that kind of lends itself to a focus on kind of high quality companies with attractive long-term prospects and management teams that are capable and honest and transparent with shareholders and all those types of things. So it's kind of all snowballed into into what it is today.
That's perfect. So for those of you who don't know, I'll leave the links in the show notes. Alex has this great Substack, so definitely go check that out. Okay, so let's actually do a double click on your investments philosophy, as you put it in your Substack. So tell us a little bit about how you orient yourself. Obviously, you mentioned some of the criteria you talked about there. Long-term orientation. You want to look at honest and capable management, et cetera, et cetera. So tell us a little bit more about that.
Yeah, I think maybe a good way to frame it is, I look at someone like Warren Buffett and think about, I wrote about Coca-Cola recently, the idea of him buying a stake throughout the period of the late 80s and very early 1990s and establishing a position size. And you now fast forward 30 years and he hasn't bought or sold a single share since 1994. And, at the start of that period, it accounted for more than 30% of Berkshire's equity portfolio. So obviously a very significant position. And again, kind of forget about the outcome on any single investment and just think about the thought process or kind of the decision making that could even possibly lead to an outcome like that. And it just strikes me as kind of very different from the kind of generally accepted wisdom about how to operate in public markets with stocks. And by the way, he did something very similar with Geico, a position that was bought throughout the late 1970s primarily. Really didn't touch it much at all until 95 when they bought the half of the company that they didn't already own and made it a subsidiary of Berkshire Hathaway. So it's just that it's a true business owner mindset that feels like a slight tweak from what most people are trying to do in public markets. But I think that slight tweak has a major impact on research process, decision-making, et cetera. When you actually implement something like that, it changes the areas of focus that are most important to you. Things like the valuation are still a very relevant consideration, but they move to a different point in kind of the decision-making process. And other factors like management quality or business quality or growth prospects, et cetera, they become much more prominent as part of the analysis. And I'd also argue, they have more permanence than some of those other considerations. So for me, that long-term focus and kind of a willingness to narrow your focus to a smaller collection of businesses that are even potential investment candidates. I think it allows this to be a game where the knowledge can compound in a way that's, again, just a little bit different than if you operate from the perspective of everything is a viable investment opportunity. It's just all, expected IRRs and you're running around potentially looking at thousands of different things versus I'm kind of narrowing my focus more and more over time to the things that I really think might pass my key hurdles.
Yeah, that's great. It's sort of akin to some of the things that you mentioned in the article, like long term, just really looking at the businesses as. There's this one guy that put it. I don't remember who it was, but I read somewhere or listened to it somewhere that think about investing as looking for your co-founder. I thought that was a really good way to say it, because it really is like you're going on this journey and you're looking for somebody that you can really entrust your, life savings or your time, your attention to. And it's as important as, finding a co-founder. If you were to start a business, like you want that partner to be trustworthy, competent, honest, all these things. I think that makes sense there. It's sort of, we have on the podcast Value Investor Checklist. So we go through some of those things. The business is good, the management, financial, the valuation is at the very end. So I think,
I think an important part of all this too, I just should add, because I don't want to paint too rosy of a picture. I think everything in this game or in life generally is about, trade-offs, and nothing's black or white. And it's kind of picking the risk or things that you're willing to be exposed to that are most acceptable to you. And, as part of this long-term and especially concentrated approach is, you have to make assessments about things over extended periods of time. And as we all know, that's generally very difficult to do. So, it's certainly not, it's not something where I'd argue it's the best way to do it objectively, something like that. I think it fits well with my personality. And I think when it's done well, I think there's some pretty clear examples from some very prominent investors that it can lead to, attractive outcomes over long periods of time.
Yeah. I like the second point there. It has to fit with your personality, your disposition. I think that's a very important. Awesome. Let's see. Let's move over to kind of the fun part and actually dive into some of the names that you write about. I know you wrote, I think, a few pieces about Roblox and a few pieces about Disney. So your pick. Which one should we go first?
Well, maybe Disney's a good one because it speaks to the point I just made about the risk and the difficulty of finding in some ways. I mean, there's also things about Disney that are still very, very, very attractive, but it speaks to the risk of, or the importance of management and importance of, operating the assets in a way that's, optimal for the long-term value of the enterprise. And in the case of Disney, they've clearly had significant management challenges over the past few years. Starting with Iger's inability to find a suitable replacement for an extended period of time. The replacement that he did find, with the benefit of hindsight, it's pretty clear that a lot of the changes implemented did not work well with the culture that exists there, and the focal points that need to be emphasized within that business for it to be successful long term. Now with Iger's return, it's a bit up in the air in terms of some of the strategic decision making. There's an endless question about the fatigue of their kind of core IP and if they press the gas too much. So there's a lot of relevant considerations that, and they have merit, that would certainly lead you to potentially question whether or not the long-term value of the franchise and the business is sustainable. So we can dive in more, but I think it's a good example of, it speaks to the difficulty of truly finding things that are going to be differentiated for many, many years or even decades. And in the case of Disney in particular, it's kind of funny, getting back to Buffett, they owned a decent chunk of Disney in the late 1990s. And I think Disney went through something, not to say that today they're having an IP problem on par with what they had then, but they did have an IP problem during that period. And I think his view on the differentiation and sustainability of what they do was somewhat brought into question. And I think that probably impacted his decision to part ways with the business. So
it's interesting. One of the things that we talked about, my co-host Hari, and we talk about Disney before this whole, post-COVID kind of rough patches that Disney is undergoing right now. We talked about Disney as one of the shining examples of how it's almost impenetrable moat, in that the content that they generate in the content business versus some other newcomers like Amazon Studio or some other Netflix or something like that, is that you have a content that has a lifetime value of that spans multi-generation. And so you put out a content, it gets watched over and over and over again, and that it's right up there. Like, the brand of Disney and the content value of the content is so high that we thought that it was really impenetrable before COVID. And then now I want to drill down into some of the perhaps mishaps. So the streaming, Disney Plus, I want to talk about that. And then the Fox asset acquisitions, I want to talk about that too. So let's go down the streaming side of the business. What is your broad take on the streaming generally? And then let's hone in on Disney Plus and their strategy.
Well, let me frame it in terms of Disney real quick, just to give a. I think generally people have an idea of what's happening in streaming, particularly for entertainment programming. I mean, if you look at somewhere like the U.S., linear TV is facing significant and sustained pressure. The viewership and ratings are the trend is even worse than the pay TV kind of subscriber declines. When you look at demographics, it's much worse for younger people, and I think we all kind of intuitively understand why, right? The the level of choice offered through various streaming services, the quality of the content, the lack of a need to be somewhere on X date at X time. You just watch whatever you want, whenever you want, the ability to binge stuff. It's just very obvious that the value proposition for streaming, for entertainment programming, in my mind, is clearly a vastly superior offering than what was available to linear. So that trend's been underway for a while. Legacy media companies were, you could say, slow to react to that, or the mechanism through which they tried to react to it, most notably Hulu, was a debacle, given the organizational structure, the ownership structure is the classic example of legacy companies with a lot of advantages being unable to kind of evolve and adapt. So everybody was really playing second fiddle to Netflix, or you can include YouTube there as well, to the extent that you view it as kind of a similar offering in terms of just, on-demand programming. So that kind of brought us to, call it the late 2010s. Disney clearly positions itself to play a much bigger role in D2C. They started with ESPN Plus, but that's a bit of a different game given the differences between live programming and sports versus entertainment programming. They're kind of two different pieces of the pie, in my opinion, and it should be thought about differently. But they go live with Disney Plus and set, these D2C subscriber targets, come out day one, and it adds, I think it was 10 million subs the first day. They blow past all the subscriber targets by a very wide margin. And if you look today, there's the Fox component in here, so it makes it a little bit messy. But you kind of look at what I'd call their video business revenues, which includes linear, but also includes, D2C and things like that. The revenue base has roughly doubled over the past 5 years. And I think that speaks to the fact that this market has the ability to continue growing, in my mind. And on the D2C side, it's pretty clear that there's going to be pricing power and the ability to, these services are not going to be priced at $6 for very long, at least in their current format. The offset to that is Disney Plus, and maybe it's easier to speak about Disney D2C as a whole. The company operated with a strategy of trying to achieve global scale, and achieving global scale, as Netflix has shown, to the extent it even has a chance of being successful, is a strategic view that's going to take years to implement, or to kind of get into place, and it's expensive to get there. You need to make investments in content. The breadth of that content is a question that needs to be answered. If you want to be global and have a very large base, you can't just live off of a couple niche brands that only serve a certain percentage of the population. You need to have a more of an all-you-can-eat model that touches these different buckets. So I think with Hulu and Star, they kind of went down that road. There's obviously customer acquisition costs in terms of promotions and other expenses. There's the tech costs in the back end of running these platforms. So long story short, they built up a sizable D2C business in a handful of years that significantly exceeded any reasonable numbers that I've seen from the street or elsewhere. But there were very real costs to get from where they were in 2019 to where they are today. And I think part of the question, and Iger coming back is certainly making this more relevant, is, does the company want to keep going down this road? Do they think this is the right game to be playing? Or do they want to refocus the organization around, a handful of kind of tentpole IP? And that choice in my view, will have a very significant impact on the role of Hulu within the portfolio, potentially the role of ESPN in the portfolio, et cetera. So I, 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 I think I've said for a long time in writing and elsewhere that I think one of the most important decisions here, if not the most important decision, is actually picking the strategy that makes sense for your company and your business, and then playing that strategy out. And at Disney, certainly right now, it feels like they take kind of a fork in the road in terms of what strategy they think is the right one.
That makes sense. What are you looking for as a sort of the next signal? So they are embarking on this decision making right now, whether to go down one door number one or door number two in terms of content strategy and how all of the tech plays and the streaming business folds into that. Where is your leaning right now?
Well, it's funny. I think Iger, well, for one, the 21CF deal was 21st Century Fox deal was in some ways a play on being broader than what Disney is by definition, right? And it gave them a controlling interest in Hulu, which is more of a general entertainment platform than the core Disney platform is, or Disney Plus is. It gave them Star, and it gave them international scale, but again, it's more international scale, but again, it's more general entertainment than truly Disney IP, obviously. He's also made certain comments about ESPN and ESPN Plus and crossing that bridge over time that would lead you to believe that he buys into that strategy, which I think is sound, and I continue to believe is sound, but it requires significant investment. It requires long-term time horizon to get from A to B. The company has pushed in the US, they pushed this Disney bundle, which includes Disney Plus, Hulu, and ESPN Plus at a pretty significant discount to the cost of the standalone pricing for those streaming services. And they've seen fairly significant adoption. And, we're getting to a point where if you decide that you no longer want to pursue that strategy, you have to find a way to disentangle all of that. And that'll be a bit problematic. The value of something like Hulu is also an open question, because I guess there's a difference between Hulu, the platform, the subscriber base, et cetera, and the content of Hulu, to the extent that you control the production of that content. I don't think anybody would be particularly interested in buying it without, a long-term agreement for that content to stay on the platform. Otherwise, what are you buying? So I just think there's big decisions around these things that need to be made. On the flip side, the company has taken significant price increases in the past 6 months or so across its US D2C services. And generally speaking, all the commentary and the numbers suggest there has not been meaningful churn. And I think, we have the Netflix example to look at here in terms of pricing power for these services. The one difference I'd note with Disney is that if you look at something like Nielsen data, their share of viewership is a lot lower than what someone like Netflix generates. And again, I think that not necessarily a bad thing for Disney Plus to have lower viewership share if it fits with the strategic vision for that business, what type of content it's going to serve. It can have a higher quality, event type of feel, a la, HBO Max, or at least traditional HBO. But again, you're not, if that's the strategy, you're not really competing in my mind at that point on mind share and potentially scale in the same way that someone like Netflix is. And that's greatly going to influence your ability to pay for content that's not in your kind of core IP. It impacts the way, leagues will think about the value that you provide to them. Think about a show like Drive to Survive on Hulu or on Disney Plus, or, for another company, Paramount Plus, relative to Netflix. That's obviously a much better value proposition for F1 to have that on Netflix than it would be on a much smaller streaming service, kind of regardless of what the economics of that specific deal are. So there's just a lot to think about with all these things. And I think there have been and continue to be encouraging signs that they can continue to pursue the strategy that they were pursuing over the past 2 to 3 years. but they also need to, show how that will work long term. Um, it's funny. I think some of this is where you're at today. Any reasonable definition of success on a subscriber basis would almost have to assume that you would face these financial impacts in terms of a P&L basis. And the disconnect there, is I don't think it's realistic to assume anything otherwise would have played out, basically. um, so that's kind of how I think about it.
Yeah. I'll just mention two things that I talked about previously in the podcast. One is there has been some reports about, so the whole strategy. One of the ways that people think about this is that you sort of put everything together. You have Disney plus all the streaming assets, and then you have the content, and then you have the Disney park, the theme parks. And the way that it works is you get people in, and the streaming business is a way to acquire customers. And it's just perhaps you can think of it as a marketing expense, and then you get them hooked on this value chain, and then customers move on to ultimately paying that Disney tax at the resort. And so that's one way that people have mentioned it and talked about it in the podcast. And one of the complaints that I've heard in writing is that the actual services in the theme parks are not as good at what it used to be. So that's one of the things that I read up on. The second thing is this whole idea of ad supported model. I think that's also kind of interesting to go down on. Netflix is sort of going down that path. Hulu famously started that. That obviously has ramification for how the company positions itself. So maybe let's talk about that last piece, the ad supported model, because I think it fits to this overall conversation about the strategy, like the overarching grand strategy. So how do you think about that?
Yeah, I think, real quick, just because you mentioned the parks, I think it's an interesting side note to all of this that Chapek, who came out of the parks to run the business, as they're going through this period where D2C is generating significant losses and obviously, materially impacting the consolidated financials of the company, they started to clamp down on the parks business. I mean, in terms of monetization, in a way that degraded the customer experience to some extent, at least. And it's just interesting to think as a CEO of a public company, the decisions you might make in a given quarter or a year for the sake of, the consolidated numbers or, what the street expects, however you want to frame it, relative to the decision making that you would make if you were just thinking about it of this is the asset that I'm going to be personally responsible for the next 5, 10, 50 years. What's the most intelligent? I just think it's a really notable example of how public companies can make decisions that are just not intelligent, basically over the long term, just pushing way too hard. And Tiger's credit, some of those things were changed pretty immediately once he came back, and I think that was really important because going to the parks is objectively very expensive. It has been objectively very expensive for a long time, and whether or not you think that's reasonable depends on how you think about what the parks is. I would argue it's an incredibly unique experience, and also that it needs to be an incredibly unique experience. To your point on service quality or whatever else it may be in the parks, to the extent they live up to the vision of what it can be or should be, I think it's a business with real pricing power and the ability to generate, attractive returns. So, on the ad supported stuff, I think everybody is still to some extent figuring it out and thinking about how to navigate this. I mean, as a user, I see it a lot. I've started noticing now when I was watching something on Paramount Plus or Peacock recently. And, now when you pause between a movie, they have a pop-up with an ad for, Arby's or Oreos or whatever it may be. I just think there's a lot of, and it speaks to what I was saying about Disney's C2C efforts generally. There's a lot of experimentation underway, especially for the companies that haven't figured out how to be profitable in this space and who may also be struggling to reach scale. There's a lot of experimentation underway to try to find out how to build a business here. So I think you'll see companies continue to try a bunch of different ideas, both in terms of monetization on the platform, but also how they, segment out their content, what's exclusive, what's licensed elsewhere, et cetera, et cetera. I think it'll be interesting to watch, but there's probably more change coming.
Yeah. Great. I think that's a great way to end the segment here on Disney. Let's move over to Roblox. You wrote this article, Roblox, the Path to Profitability. So to start us off with maybe just a quick description of what it is. Some people may not know what it is. So you give us a quick description of what that is and talk about your thesis.
Yeah, it's a good question. The big question I asked in my first write up on Roblox, I kind of led in with, hey, I went on the platform and started playing on it or whatever you'd call it. And as someone who's in their 30s, I was maybe confused isn't the right word, but it certainly wasn't the quality I was used to from playing FIFA or, Call of Duty or something like that. It's something very different. But then you look at kind of the KPIs and, now pushing 60 million daily active users, up 6x from early 2018. And, I just think that question, what is Roblox, is a really important one. And so as I wrote in my, first look at the company, I think this is kind of the core question, what is Roblox? And for someone like myself, I'm in my early 30s. It's very different from the, what I think about when I think about gaming platforms like an Xbox or PlayStation and, FIFA, Call of Duty, really high quality, like AAA games. And Roblox is something very different than that. But I think when you look at the KPIs and look at the growth of this business over time, and you look at the engagement of their DAU, something on the order of 2.5 hours a day for, roughly 60 million people now, which is up 6x from early 2018. I think it speaks to this being something different than, what I personally think about when I think about what gaming is. And maybe it's the nature of the platform in terms of access and premium, which makes it, the hurdle to start playing is obviously very different than going out and buying a console for $300. And there's also surely some of these social considerations and things that make it much more than just the gaming platform. So, I'm still personally trying to think about how that evolves over time. The metrics on kind of aging up and users in their teens and even older is very encouraging. It's also a space with a ton of competition in various ways. And I'm fascinated by the industry, but I've still yet to kind of get my arms around who are the clear winners here as we look out 10, 20 years.
Yeah, I think Roblox is interesting. Like you mentioned, what is it? It's a very profound question because, like you said, it's not like anything that I've seen before. I think what is interesting about it is the lack of high quality in terms of the aesthetic, the design. And then another thing that's interesting is it's all user generated content. Or Roblox provides a platform. When you think about Roblox, you think it's one game. No, it's actually, it's like more games that you could play. It's like thousands and thousands of games in there. So I think that's interesting. The user generated content, like the platform play, it's almost akin to YouTube, where, YouTube provides this platform and creators can monetize on it. If you look at the line item on Roblox, they'll actually say developer compensation on the line item in the P&L set. So it's like paying out YouTube content creators.
Yeah. And to your point before too, maybe I should add this as well. I mentioned the kind of the deep dive, the first article I wrote about Roblox. The most recent one, as you said, was, Roblox, the path to profitability. And I think it kind of speaks to what we're talking about with streaming as well, is, as companies go through these periods where Mr. Market gives them different signals in terms of affirmation or kind of question marks, I think you do see it start to show up even on the margin in terms of how they think about, their expense structure, or, what their focal point for the business is, how long it's going to take to achieve, success on certain strategic priorities, et cetera. I think in the case of Roblox, you have an interesting example of a company that, for now, has been extremely high growth business. I think the past 3 years, bookings have grown at like a 60% CAGR. But it's also a company that has struggled to achieve consistent profitability. Probably isn't even the right wording, because it hasn't been their primary focus. They've been investing in order to continue to sustain, growth that is kind of unmatched in the industry. And I just think you go through a period like late 21 and 22, and you see companies shift a little bit more to kind of demonstrate that they're more than just a product that is really liked by their customers. They're building a real business. And Airbnb is probably the best example of this, from the transition they went through, in the early days of COVID, where there was a real risk the company was going to not exist anymore. Basically, if they didn't raise capital because of how significantly they were impacted by the pandemic. But even on the back end of that, you see how they really focused on building a business as opposed to a platform that adds value for users alone. Find a way to do both, obviously. I think Roblox is starting to show that they have a path to get there as well.
So maybe just for listeners' context, can you walk me through how they actually make money?
Sure. Well, the main thing that they do is they have, forget the number off the top of my head, I want to say it's around 20% payer penetration. So people who buy, they're called Robux, which is basically the on-platform currency. And people buy those either through, they buy them through mobile app stores, or they buy, prepaid / gift cards at Walmart or wherever else. And they use that currency to purchase things, clothing and, other accessories on the platform. And the developers are paid a cut of that, but Roblox also keeps a portion of that as kind of their compensation. So the business is, as I mentioned a minute ago, the relevant metric is bookings, which is basically just a variation of revenues with an adjustment for the timing of when those dollars basically are recorded for a GAAP basis in terms of revenues. But yeah, so Roblox has increased their bookings, as I mentioned a minute ago, at roughly a 60% CAGR. I think, if I'm not mistaken, the number for last year was 2.8 billion. I think that's right.
See, I'll show the screen here.
I have it somewhere.
I'll just flash.
Yeah, 2.9 billion in Q4 was the trailing 12-month number. So this is becoming a fairly sizable business, and they have certain expenses like developer fees that will continue to be a prominent part of the business. And, but there's other line items like R&D or G and SG&A that, the idea would be over time they can have operating leverage on those expenses as they continue to grow and run the platform more efficiently. And I think, if you look at their results in 2020, which was obviously a very unique period of time given the tailwinds that COVID provided to them, I think you can see how the expense structure can evolve as they continue to grow, but also become more efficient.
Mm-hmm. Great. What
to be clear, I'm not on the stock, just in case anybody, because I praised it. I own Disney, which I talked about previously, which I did not praise nearly as much. So that shows you how I think about these things.
Yeah. I mean, it is pretty astounding the level of growth that these guys were able to achieve. It's, I'll just anecdotally say some of you who are listening, may have kids in 7 through, I don't know, like 12 years old. But in my previous company, I worked with a lot of parents who have kids in that age range, and that's all they wanted. Roblox, like Robux, give me a Robux for Christmas, my birthday. Like, everyone, because everyone's on it. People are playing Roblox with each other. So that, as most of like FOMO when you're that young is really strong, right? You want to be with your friends at all times. And if your friends are on Roblox, you also want to be on Roblox. And the desire to have all kind of skin, like is very strong. So I think I read somewhere that the amount of sale, like clothing, the skin sale done on Roblox matches one of the biggest retailers of clothing, like just like actual clothes. So you can kind of see the volume there.
Yeah, I first learned about it from my good buddy who's also an investor, Francisco Olvera, and he has kids, and he tells me about how they use it. And then I went on a trip with some family, and I saw my cousin, who at the time was probably 10 or 11. I saw him using Roblox, and kind of to what I was saying earlier about, my view of what a gaming platform is relative to what this is. I realized it was something different, that it wasn't just turn it on and go in a game and start playing. There's something different happening here that I'm too old to understand, but I'm trying to at least vicariously figure out what all these young kids are doing.
Yeah. Great. So that was great discussion on Roblox. So that's it, guys. So Disney, Roblox, there you have it. Interesting takes. If you guys want to learn more about Alex's work, definitely check out his website. I'll leave that in the show. That's thescienceofhitting.com. Awesome. Alex, great to have you.
Thank you for having me. I enjoyed it.
Yeah, awesome. All right, guys. Thanks for listening. I'll check you guys in the next episode. Thanks.